Good morning, everybody, and welcome to the Fred Report Technical Market Call for March 10th, unbelievably, 2011. Got an interesting day going here. So far, the market's acting about as we've expected this week. We are so far still holding that 130 support area on the SPY, which is equivalent to around 1,300 on the S&P 500. We still expect a break of that area. We would like to see the market go to 124 to 126. We think that will set up a good buy point in the second part of the year. We may not break it right away. We may rally back up from here and then come down. For that reason, we are still adding money to big cap names. We like staples. We like discretionary. And we like... what's the other one I like? Materials and even industrials. The trick here, guys, is to add the money in slowly and realize that if we're right and foreign money starts to come into this thing, on the way out of this correction, assuming we really get the correction, the big cap stocks will really take over the baton and start to leave. Meantime, I've done some stop losses for some of you guys that have sent in emails. I would just examine your stop losses. Most of us did that back in December. The market is considerably higher than we were in December. So I want to just make sure those stop losses are up okay. There is nothing here, by the way, that suggests that this is the end of the bull move from 2009. There's nothing at all. But there's a lot of overbought on my weekly and monthly indicators suggesting that a sharp drop would be very, very healthy and very, very good. The other thing I will mention, again, I know I've mentioned it in the reports, but, you know, this Middle Eastern business is a tremendous concern to me, mostly because we're not seeing the sentiment indicators tick up at all. The put-call ratios are still elevated in favor of calls. Percent bears on Investors Intelligence last week was 19%, still below 20 even. You know, this is a great wall of worry, but people are not worrying, and that is the concern. So given that, when you see a situation like that with sentiment numbers, usually what happens is the market corrects, and then afterwards, the end of the correction is a little more violent and sentiment shoots way up. So just be aware that we could see a little bit more violent a correction later on if these sentiment numbers do not pick up and the market keeps going down. And with that, we'll leave the market for a minute. I'm sure we'll have some questions on that. On the bond market, it's struggling short term, but it's still trying to rally. You know, we still like the corporate bonds. The LQD, as long as that stays above 107, we have basically still held the breakout from the last year, from 2009, 2010. And so we would be adding money to bonds right now, with the idea being that we're going to get a run in bonds now, and in the first half of the year, that run will peak, and then the second half, as things improve economically, we'll see rates starting to go up and bonds come back down, I think, to about where we are. The only other thing I would mention is the emerging markets bonds, EMB, those I talked about in the letter a little while ago. That ETF is actually trading a little bit better than I feel it should be, but if you want to speculate, that may be a place to speculate. I would not put client money in there that's not afraid to sell or afraid to take a loss if it doesn't work, but that might be a decent speculation. You might get a little bit of a higher yield overall. Looking at our HYG, the U.S. Higher yield bonds, that's correcting. That often acts as a proxy for risk in the markets. If that gets back down to 90 to 90.50, that would probably be a decent place to look at HYG, and if it does that, I'll do a piece on that. Looking at the commodities, the interesting thing here is the ETF did not break out to new highs on the GLD by much, and now they're retracing. We will use this drop to add to commodities, especially gold and oil. We are not as big on SLV. The silver, although that's been trading a little better, that's one of the signs that commodities could come down. We still could see a chance at buying the SLV Victor around 30.50. Note that the DBC, which is our main commodity index, basically got into that 30 area. It's now below it. A retracement into the 28 area would probably be a buy, and so we're interested in that. And the currencies are important here. Because what's happened is FXE, the euro, had basically gotten right up to 140. It came very, very close. That's the main resistance. It started down, and we're seeing some issues with Spain and downgrades and stuff like that. That suggests that the dollar is setting up for a move into the second half of the year. And if we get that, one of our themes for this year was that Eurozone problems could occur, and we could see the dollar and commodities go up together. So we're watching that. If you start seeing mainstream research saying that commodities and the dollar cannot move together, there's an excellent chance that that's going to be a very good trade. And so we're going to look at that and possibly play that with alacrity should that occur. Turning to some of the stocks, IBM broke out to new highs yesterday.